In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again to all of our market rebels and to everybody who has been helping out and participating in Coach's Corner. Stu, thanks for making it again today.
Yeah, thanks for having me, Bill.
Of course. Well, we are part of the permanent duo. We tried to get Scotty on. He was not available, but we'll try to get him on next week. But for anybody who's new, it's great having you here. And the main thing that we try to do is to show you a lot of the tips and tricks of professional traders that you're probably not going to see anywhere else. And as you have more information, you're going to make better decisions. So Stu, we got a very cool one on deck today.
Yeah.
And I'm going to start off with a little question that we always do that we call Chalk Talk, our little huddle here for the Coach's Corner. So this is supposed to be a little thought-provoking question just to make you think. We'll come back at the end and answer the question. But for right now, let's say the stock is $500. You're looking at the at-the-money $500 call trading for $10. You look at your broker's platform, it says it has a delta of 50. And the question for you, if the stock rises 1%, what percent will the options price rise? Good question, huh?
Well, I mean, we talk a lot about leverage and how options give you leverage. And, one of the things about risk management is how much leverage do you really want? And
That's
even
right.
more so, how much do you really need to meet
to accomplish your goals? And that's one of the reasons you have to understand these calculations that we're about to show. Another use might be if it's an out-of-the-money option and you're hoping maybe that it comes back into the money. Not that that's a good strategy, but a lot of traders do that. Well, how likely is that to happen? How quickly is this option going to appreciate if the stock rises 1%? So there's a lot of different interpretations that we could use for this. But for right now, we just want you to think about it. If you have an idea of how it's done, you might want to just jot it down. If you can come up with a formula, kind of jot that down. And then we'll come back and test your intuitions here at the end and see how you did. Now, the second question we're going to ask here is actually going to be a two-part question today. Will that percentage change remain the same? So let's just say hypothetically that you think if the stock rises 1%, that your option's going to rise 10%. Okay, if that's true, what if the stock rises another 1%? Will it always be 10%?
Yeah.
Okay, so that's another question.
What we know about options and curvature, I'm probably going to go with negative.
I knew you'd know that one. And I know you already know the formula here, but that's exactly the way to back into it intuitively. Yeah, that should be. If you understand your options theory, you would see that that can't be true. So for today, for everybody else, let's talk about how much leverage does your option have? Okay, good question. So leverage, let's start off with the basics here. Whenever we talk about financial leverage, it always is created by borrowing money. Now, what's interesting about the options market, people say, well, hey, I bought a call. I didn't borrow any money. Well, mathematically, you did. If
Yeah,
you have
sure.
a $100 call, you are mathematically borrowing the $100 strike.
Yeah,
That's coming out in the calculations. We can
yeah.
also show that synthetically. We talk about that in Q&A all the time. We show how we can combine them to come up with a bond, a risk-free bond. And that's another way to show that the cost of carry is absolutely entering into that calculation.
And that's a really easy concept to really swallow, to really kind of take in. If you think
Mm-hmm.
about in the money calls, and even really deep in the money calls, where maybe it's $100 stock, and maybe you're buying the 70 or 80 strike price. Hey, if it's the 80 strike price, look, you're paying $20 for it, right? You pay a couple of dollars, maybe in extrinsic value, but that's your premium. Forget about that. You're paying you're paying the $20, and you're really borrowing the 80, right? And
Correct. Right. That's why you're able to pay the 20. Right.
that's why you're able to pay the 20. And there's always, no matter what money you're borrowing, unless somebody's giving it to you for free, which is not really likely, there's always going to be a cost, right? Always think about it. You get a car loan, you get a mortgage, you get a business loan, whatever it is that you're getting, there's a cost involved to it. And that's what we're talking about here.
Yep. And that'll always come out in the calculation. So anyway, implicitly, you are borrowing money when you're buying call options. Now, let's start off with a little definition of delta, because when I pose that question about how much leverage is in your option, most traders think that the answer lies in delta. And if your intuition told you that, that's a good start. That's good. We're going to find out it's not 100% correct. It's not just in delta. But traders often think that you can divide delta by the options price.
Now, I hear
And
that a lot, actually.
yeah. They reason it this way. Let's say that the $100 call is trading for $2 at the money, and you look at your platform and it says that the delta is 50. And they'll say, all right, well, if I take the 50 delta, or the 50 cents, and I divide it by the current price, that's going to give me 25%. In other words, we all know that if the stock rises $1, that's kind of the loose interpretation of delta, that this option will go from 2 to 250. So therefore, it's picking up 50 cents on a base of 2, or 25%. So they say, oh, well, if it rises 1% or $1, I'm going to pick up about 25%. Well, we could go to a pricing model. We put that in the certain parameters, time to expiration, volatility, so we get a option price of 2, and then we change it to make the stock price go up 1%, and the pricing model says it's 255. And that's 27.5%. Now, the reason it's not working out perfectly here is that there's also gamma.
Oh, there's that curvature thing.
There's that curvature thing again. But you can see that for practical purposes, it's a pretty good estimate if you think 25. That delta divided by the call price. The reason that that's not going to work across the board is that this is just a fluke. It's a coincidence, because a 1% increase in the stock at 100 is $1. And a $1 increase, if we want to use the delta interpretation, is also $1. So they just happen to be that a 1% increase equals $1. And that's why a lot of traders think, oh, I use this as an example and that must always hold. And it's close. It's part of the puzzle, but it's not the whole thing. So to show where this can really fail, let's say that you have a stock at 500. Seems like we've seen this question before. $500 call is trading for 10. Now also notice, what did we see in the last one, Stu? We had a $100 call with the stock at 100. It was at the money. I've now made the stock price go up 5-fold. What's going to happen to that call's price?
Well, it should go up 5-fold.
Should go up 5-fold. The last one was 2. This one's 10. You'll see that that's always true in a pricing model.
Little side note, sidebar for a second here. I'd like everybody to just kind of think about that. People talk about, oh, this option is expensive. This option is expensive. Well, think about the stock.
Yeah.
If you have $100 stock and since $2, if it's $1,000 stock, it's times 10.
Yes.
Right. It's and that becomes
right off
the price.
Bat. Yep.
Right off the bat, that becomes the price. It's a multiplier of how much you're going on the stock. So, look, you gotta think about that. And then you got your delta and how much can the stock move relative to the delta. Things are getting, stock prices are high these days. They're not high, I'm saying overvalued. I'm not saying that at all. I'm just saying they're not $50 anymore
Right.
for the most part, or $30 or $20. When I started trading, it was like everything was $20, $30. Now everything's 200, 300, 400, 500, $800.
1,000.
Thousand, 3,000, booking. What's booking? Is it booking these days? No, book. Yeah, Chipotle split. It's like
Yeah.
$4,000. Something crazy.
It used to be that if a stock hit 100, it was on the front page of the Wall Street Journal.
And that
And
was
barely
big.
like unbelievable. Can you believe
Yeah,
the stock? Now they're all above that.
they're all above 100. So, look, doesn't have a lot to do with this conversation, but just kind of keep that in mind, people, that, stock option prices are a function of many things, and one of them is the stock price.
Right. So the thing is, it will scale out proportionally to the stock price. That is not true for time or volatility. There's a square root thing that we have to do in there. But you can see here that if we made the stock price fivefold, the option price goes up fivefold. But here's the catch. The delta, because it's an at-the-money option, will stay about the same. It's still a 50 delta. So now you should see that this formula is going to break down. So let's say that the stock rises 1% to 505. And if you say, all right, let me take my 50 delta and divide it by a $10 call price, what is that? That's only 5%. Well, the pricing model says that this $10 call with the stock at 505 is going to be worth 1276 or 27.6%. Well, that's a far cry from 5%.
Yeah, what happened here? And if
See,
you think
something happened here. We cannot just take delta divided by the calls price.
right, look at the mistake you can make. Oh, I need the stock to move this much, and I'll make my
Right.
money, or I'll make this much in return, and
Right.
it falls apart.
Yeah, this is okay if you want to say for the next dollar move, but the next dollar move isn't a 1% move. Look, this is $5 right here.
Right, exactly.
That's not a $1 move. So before we get further into this conversation here, please remember to join us at marketrebellion.com/get started. We have a whole bunch of videos, articles, and things to help you get a firmer footing into the world of options with theory and pricing, with our put call parity formula that we've talked about before, all the things that you need to make better decisions, all free. So check us out there. So let's do a comparison here, Stu.
Mm-hmm.
Let's look at the stock at 100 and then the stock at 500. And let's say that both stocks rise 1%.
Okay.
So if we put that in a pricing model, our stock at 100 when I had a $2 option, pricing model, if we increase it by 1%, says it's worth 255, which we saw before is 27.5% increase.
And don't get lost in that, everyone. Think about that. It's $100, and we're talking about a $2 rise here, Bill. Is that right? A $2 rise?
The 55-cent rise.
No.
Oh, well, I'm sorry. Well, a $1 rise in the
$1 rise. That's right. Run $1 rise on a 50 delta option, kind of
Right.
at the right. $1 rise on a 50 delta option. You're talking about roughly 50 cents. We're not, he's got a little gamma in here, like we talked about, and there you go, 2 to 255.
Yep. Now let's do it for the stock at 500. It was a $10 option that rose to 1276, and it's 27.6% increase. So now look at these numbers.
Yeah, well,
see, now they're much more in tune if we put them into a pricing model. But when we looked at just delta divided by the options price, we were okay if the stock was 100, but we weren't okay if it was 500. So there's something else that's going on here that we need to use for this calculation to come out consistently. And that turns out to be, now don't panic when you see this, it's a fancy term, very easy to understand, but it's called an options elasticity. How do you like that for a term, Stu? And this is used in economics a lot. And if you just think of the word elastic, something that stretches, that's kind of where it got its name, is saying that if something rises 1%, by how much will this other thing stretch or rise?
I thought it meant how much will my belt, like.
It could be. Yep. Thanksgiving time, that definitely happens. Okay, so elasticity shows the percentage change in your options price for a 1%, not a $1 move, a 1% change in the stock's price.
Mhm.
So now here's the formula for elasticity. Let's take the stock price times delta.
Yeah.
And if we do that, this is actually showing you the equivalent number of shares that you're holding. And that turns out to be important. It's not just delta, it's the equivalent number of shares.
And everyone, look, that's what delta is.
Yes.
It's yeah,
Right, the
it's
proportion.
one contract, or it's 10 contracts at a 50 delta. It's 500 deltas. It's 500 looks
Equivalent
like
shares. Yep.
it's gonna make your P&L look like 500 shares worth of money
At that moment, correct.
at that moment, up or down. That's how I learned it way back in the day, and that's what the real deal is. It's what does the position look like? How will it act with a $1 move in the stock?
Yep. So if we take our stock price, the current stock price, times the current delta, again, think of that as the equivalent number of shares, and we divide that by the options price.
Yeah.
Now we're getting somewhere. Now notice that the delta divided by the options price in red is what we started off with, what a lot of traders think. We have to increase it by the stock's price or scale it by the stock's price. Now, interestingly, for all the math people out there, they will recognize if you are multiplying in the numerator, there's a lot of different ways I could split this apart. I could say the stock price divided by the options price. That's kind of one thing, and multiply by delta.
It's the delta, yeah.
Or I could take the stock price as one thing and multiply that by the delta over the options price. So that's exactly what we're going to look at here. I could take the stock price times the delta over the options price. And we can see that's the formula that we started with that a lot of traders think is the way you would figure this out. But notice what we did here. We had to scale it by the stock price. That's what's going to be the key to making this formula work out all the time. Now, incidentally, and I think we've talked about this in Q&A as well, this concept of elasticity is used a lot in trading. Sometimes it's just for simple decision making. But one of the more notable uses is for beta weighting an option. If you have a portfolio of options, let's say you've got 10 different tickers, different calls, puts, and you want to weight the portfolio so that you only buy S&P 500 puts to protect it. You don't want to buy puts on each individual name. Well, in order to figure out the equivalent number of puts to buy, you would need to know the elasticity. That comes up in a calculation. So it's used quite a bit, but this is kind of a simple use of it.
All right, so it's so funny that you say that, Bill. When our company got bought by Goldman and we were working for Goldman, all of a sudden I started hearing that term like a lot.
Yeah.
The whole, elasticity thing, the elasticity of an option. And, I was a little, just a touch fogged by it, but it really made sense. I talked to a couple of people about it and it really made sense because, think about it, Goldman Sachs, they have billion, I don't know, they have giant portfolios.
Giant.
They need a way to really, kind of put the whole thing together and say, what's the elasticity? If this happens in the marketplace, how are these options going to behave in a big picture general pattern? And this is the kind of stuff they use.
Absolutely. And if you think about it, that's the dilemma that most traders fall into. Oh, I've got NVIDIA and I'm either underwater or whatever the situation is. What should I do? What do you think is going to happen? How much is this option going to move? They have so many questions, but a lot of it a starting point is let's see how sensitive your option is to a 1 percentage point move in the underlying stock.
Which makes a lot of sense because that's how stocks move. It looks like they move by dollars, but they really move by percentages.
Which again goes back to why it appeared to work when we did it with $100 stock, because a 1% move is also exactly $1, which is the definition for delta. So that's kind of a little quirk. It worked there, but it's not going to work across the board. You have to multiply by the stock price. So let's take a look at some other points about this. And before we do, quick reminder, please join us, marketrebellion.com/get started. All kinds of good stuff and free. Can't beat the price. Now,
Free.
let's talk about kind of our part two question that we started off with, that will this leverage, whatever number what we come up with, we came up with about 27.5% here. Question is, will that always stay the same? Remember that first Chalk Talk question, we were saying, is that percentage going to stay the same? And you mentioned your intuition tells you because of curvature, the answer is no.
No.
And that is correct. In fact, it's going to converge to one leverage.
I say, well,
Meaning that if the stock goes up 1%, your option's going to go up 1%. But where does that happen? Well, it turns out that's going to be super deep in the money. And here's why.
Way in the money.
Way in the money. So let's say the stock is 200. $100 call is trading for 100, just trading at parity. Delta is obviously 1.
Yep.
Let's run it through the formula. $200 stock times the delta.
Let me get my calculator out. Go ahead.
Yeah, 200 times 1 is...
Times 1. Let's see. It says 200. Okay.
And then we divide by the options price, which happens to also be 100. Now, remember, this is the call price, not the strike. They happen to be the same in this one, but we're dividing by the call price. And what do we get here? We get 2.
Yes, we do.
So what this means is that our leverage factor is, in terms of percents, is now 2. If the stock rises 1%, this option's going to rise 2%. Not a big difference. Still not at 1-to-1, but we would eventually get there. So for instance, you did say we had to go super deep in the money. Let's put the stock up at 1,000.
Ooh, that's a big move. That sounds like ASML going the other way.
That would be a very big move. $100 call is trading for the difference, or $900. Delta is still obviously
happen, right, Bill? I mean, didn't NVIDIA go from like 50 to 1,000?
About, yeah, with 100 to 700 in a short time for sure.
Felt like it anyway, but yeah, I mean, these stocks move.
They can. But the delta, remember, that's the maximum delta. So if it was a delta of 1 with the stock at, what do we have it there, at 200, it's certainly going to be delta 1 here. So what does our formula show now? We have a $1,000 stock price times a 1 delta. What's that again, Stu?
Let me see. Hold on. 1,000.
So we take that and we divide it by $900 call price, which comes up to what? 1.1.
1.1.
Right. So 1 point. So what you're saying is that if the stock rises 1%, you're going to pick up 1.1% in your option. So that's why we say it eventually, big emphasis on eventually, will converge to 1-to-1. But here's what it looks like. So here we have stock prices across the horizontal. These are the elasticity numbers that we came up with. And if we look here, here's the at the money. This black line is for the $100 strike at various stock prices. Now, you might be wondering why this is so asymmetrical, why it didn't come way down here. And that's because I think this had an option price of 5 cents. If you went below it, they were not even registering a price. So I wanted to go to the cheapest option price that I could. And we can see that the elasticity is like 45 times up here.
So visualize, everyone. We're talking about a stock price that's 100 and
100 and a $100 call with the stock at 90. You're 10 points out of the money.
10 points out of the money, and you got a high,
very high elasticity.
Yeah.
If the stock moves to 95, still high, maybe around 35 or so,
but lower.
But lower. And at 100, this is what we saw, kind
lower.
of up around 25 or so. And then we can see that we start falling off, and eventually we do just start to flatten. And if we went way up here to 1,000 or beyond, we would eventually hit 1, and then we would never get below that.
And see how stock price is like 140, 150, right? That option is way in the money now.
Very deep. That's 50 points in the money right here.
Way in the money, right?
So this is another thing. If you're after the leverage, you might say, at what time should I roll it? Where am I going to start dropping off? And these are all things you can calculate on your own. We're going to do some examples in a pricing model in a moment. Now, here's a question for you. What if we increased the volatility or the time to expiration? What do you suppose is going to happen to that curve, Stu? Is it going to get steeper, flatter? What's going to happen?
If you increase the volatility
or the time, or both,
that elasticity is actually going to decrease.
Very good.
Right, it's going to decrease. Think about it, everyone. Those options are moving towards, not to, but towards that 50 delta they're kind of
Right.
looking like more like each other.
I like that. That's one way to look at it. I'm also saying that the option prices are just going to get more expensive.
Mm.
You're
Yeah,
looking at that 50 delta divided by a $2 option versus a $10 option versus a $20 option for the same stock price. And so, yes, that's another way to say that it absolutely must decrease. So I always remember
you know what this reminds me of? Not too long ago, and I kind of forget what stock it was. It was some stock that had warrants on it, one of the car makers, where the put spreads were everybody was selling the put spread at $4,
oh
$5
yeah, yeah, yeah.
thinking like,
Carvana, I think.
yeah, I don't know which one it was. It was something that had a warrant attached to it for a while. It was like, how can I lose? Well, everybody lost.
Everybody lost.
Yeah, it's like,
Markets
right?
get real good about that.
Yeah, yeah.
So the thing is that I think I had 23 days to expiration and 20% volatility. And the reason I chose 23 days was so I could get that option to come up to be exactly two. It was just for the example. And then when we made the stock price 500, it made it exactly 10. But it doesn't matter. Put
No.
your parameters in a pricing model and then increase the time or increase the volatility. And what's going to happen is your curve is going to do this. All right, so now we've got the same $100 strike at, let's say, 30% volatility, still with 23 days, or at 20% volatility with a year to go, or increase them both, increase the volatility and the time, and you're going to start flattening out that curve. Okay, so there's your at the monies. You can see very sharp drop off in those elasticities. So let's do a quick demonstration here, Stu, on our pricing model. And before we do, let's go ahead and do it while I've got the slides up here. Let's knock out our chalk talk. So what'd y'all come up with? Stock is $500 call trading for 10. Delta of a half. Stock rises 1%. What percent will the options price rise? Would you come up with? If you put that in the formula, you're going to come up with roughly 25%. You'll be off by a touch because of gamma, but that will be
But an immaterial number, we'll call it.
It's an immaterial number. So if the stock rises 1%, you should pick up 25%. And then part B, will the percentage remain the same? Absolutely not, unless you're super deep in the money. Then you're going to just converge to one.
It's really, in the big picture, makes a lot of sense, Bill, because super deep in the money means it just looks like stock anyway.
It's like stock. It has to be 1-to-1. That's another way to come up with it, right? So let's come up with a pricing model. And I'm going to put you to the test here, Stu. Now, this is one that we use a lot in Q&A. This is from barchart.com. It's free.
Yeah,
I'm going to put in some prices. Let's make something up here. 600.
Okay.
600. Days to expiration, I'm going to put 60. Risk-free rate, I'm going to use as 0. Volatility, let's make 20%. Dividend is 0.
And
okay.
Tell everybody why we're using 0% and no dividends, Bill.
Well, again, because the cost of carry will start to throw the calculations.
Right. We're trying to isolate what
we're trying to isolate just the effect of, yep. Yeah, that's one of the reasons I always take risk-free interest rate out of the equation. It's not that it doesn't count, but we're trying to just hold all other factors constant.
Unless, of course, we're talking about changes in an option price due to an interest rate.
To an interest rate, right.
Exactly. And then we would make the other ones, we would negate the other ones.
We would hold all of those constant. We'd hold volatility constant and the stock price constant. Yep. So here we go. If you have a piece of paper, you might want to jot this down. It's telling us that the options price is 1940.
Okay.
Now remember what the elasticity is saying. If we increase the stock's price by 1 percentage point, all things being equal, so not 10 days later or 6 months later, okay, 1 percentage point, this option should rise by how much? All right, so what's our formula? Let's pull up a calculator here. Anybody remember what the formula is out there? We said take the stock price, which is 600 times what?
Times delta.
Delta, which is, delta is 0.52 times 0.52 equals 312. And then we divide it by the options price. So we divide by 19.4 equals about 16.08. So that's about a factor of 16. So if the underlying rises 1%, we should pick up about 16% in this option. So let's see if it works. What is a 1% rise in the stock price? Would be 606. All right. Now we go to 2265. And what was our, let's do 22.65 divided by what was the other price?
1940.
19.4 equals 1.167. Okay, so there you go. I can tell that that's going to pick up about 16, 17% if the stock makes a 1% move. But right now, not 6 months from now, it's always about an instantaneous move.
And at 20% volatility.
And 20%, everything else is staying the same, right?
Yeah.
Right. We're not writing up a skew curve or anything like that. There's a lot of things that can complicate it. But for the most part, it's probably not going to be a decision breaker, right? If 16 is the number you're looking for and it really comes up to be 15 or 14, you're like, well, it's still in the ballpark. So it's not going to be perfect again because of gamma, but it's certainly better than taking the options delta divided by the options price. So anyway, we thought that would give you another little tool in the toolbox to help you make decisions. And that's really what it's all about when you are trading options. The person with the most information who can make the best analysis about an option's fair value is going to make the better decisions. And that's really what it's all about.
Fair value. Man, that is another topic.
Another topic for another day.
Fair
But any
value.
closing comments here, Stu?
Look, Bill, this is one of 1,000 tricks of how we do what we do. For this and a bunch of others, and trying to figure out the language, give us a call. Talk to the salespeople.
That's a good point. Yep. We can show you the little tricks out here, but there's a lot of applications. Why would you use this?
Why would you use it? Yeah,
how would you use it to hedge, roll, and more? If there's a lot of applications, how would you beta weight a portfolio? So if you're really serious about going to the next level with your options trading, like Stu said, give us a call. Call us at Market Rebellion. Phone numbers on the website there. Speak to a sales rep, and you can speak to Stu or Scotty and get coaching lessons on things exactly like this, or join us in Q&A.
Yeah, Bill and I do 3 Q&As a week. Two, 3.
2 of the general ones. 2, 3.
We actually do 4 in total. With a couple different subscriptions. One of which Bill and I do by ourselves. So yeah, you're not going to get this in too many places. In fact, I haven't really ever seen anywhere where you're going to get this. Come give us
all
a
stuff
call.
that we love to teach, and so we'd love to have you join us. And we hope that you learned something here, and we hope to see you next week, next Thursday, 4 p.m. Eastern, for our next edition of Coach's Corner, and we'll see you then.
Take care.